Hi Chakits, I have been following you and watching your YouTube channel for years.
I have decided to finally relocate to Las Vegas and want to start a new chapter in my life. I know you're the perfect realtor to help guide me to find my next dream home. I am looking for a modern kitchen, large backyard with a pool and a golf course community.
My name is Chakits Krulsawat with Simply Vegas, a licensed real estate agent out here in Las Vegas, Nevada. I help buyers like this all the time, so if you're looking for a licensed professional, give us a call at 702-319-1092 or visit lvhomeexperts.com. Buying a home starts here. Is your credit score holding you back from purchasing a home? GC Credit Coaches is a repair company that's made easy. Their goal is to challenge and remove all negative errors that hurt your credit score. On average, GC clients see about 10.2 negative items removed over 4 months. Start improving your credit score today with a simple 2-minute online enrollment for a free consultation and a complete credit audit. GC Credit Coaches offers competitive monthly pricing, no contracts, no hidden fees, and the service stops once you are satisfied. GC Credit Coaches removes inquiries, collections, charge-off bankruptcies, and repossessions. Don't forget to visit gccreditcoaches.com. All right, and welcome to the LV Home Experts podcast. If this is your first time tuning in to this podcast, my name is Chakits, licensed real estate agent out here in Las Vegas, Nevada. This is where we talk about real estate financing and just what's going on out here in Las Vegas. So today we have a very special guest, and you've probably seen her before, Celeste. She's been on our podcast how long ago?
Oh my goodness, probably about almost 2 years ago.
That long? It can't be that long. I would say
maybe a year ago?
Maybe a year ago. So I don't remember having this podcast for 2 years, but...
It was a year ago.
Oh.
I'm pretty sure it was like early 2022.
Okay. So the last time we spoke, you worked with a mortgage company, and now you're with a different company.
That is correct.
Okay.
So I recently moved to a new mortgage company. I'm now with a company called eMortgage Capital. I just switched over yesterday, actually, and it's really exciting for me because for my entire career, for almost 6 years, I've been on what we call the retail side of mortgage.
Okay.
And now I'm with a non-delegated correspondent lender. So we have, a partnership with an investor where we go non-delegated, but we also have access to a vast broker channel where I can shop for loans and price interest rates with 130 different lenders.
Now, non-delegated, what does that mean?
It basically means that I am your loan officer. I take your application. I get you pre-approved.
Mm-hmm.
I find the best mortgage company with the best product for you with the best interest rate. And then I send your loan file to that company, and we use their underwriters and their closers and their funders, and they finish out the loan for us. And so the loan will be in that company's name sometimes, or sometimes it'll be in eMortgage Capital's name.
How do you know which is the best loan for that person?
Well, it really just depends on that individual's specific qualifications.
Mm-hmm.
So mortgage loans, they're not cookie cutter. So what I might recommend to one person, I would recommend something different to another person. So when we're taking the application, we're really diving deep, and I'm asking questions what is your budget? What is your budget for the monthly payment? What are you comfortable with? What is your budget for cash out of close? We're taking a look at the credit. We're taking a look at the income. All of these things make a big difference when you're choosing a mortgage loan. And so we're really trying to find the loan that fits that client's life.
So what type of loans are out there right now?
There are a variety of loan products. So we have like our agency products like VA, FHA, conventional. Then we have our jumbo products. We have our non-QM products. So if you're looking at a bank statement loan because you're a business owner, or you're looking at a DSCR loan because you're an investor and you need that type of product, we have all of those. But on the broker side, now we're looking at land loans, hard money loans, things that you don't have access to on the retail side.
So your company also provides hard money as well?
Correct. Yes. So we could do hard money. We could do commercial if you want to. You can do, there's so many different options out there. It's not just, on the retail side, all you have access to is what your company offers.
Okay. So it sounds like your company pretty much does it all.
Yeah, it's kind of like I'm like a hybrid kind of. I kind of get the best of both worlds.
Okay.
Where we're still a direct lender. We're still non-delegated with certain investors, but we also have the option to broker out your loan, go through the broker channel, shop for the best interest rate.
Okay. So some of these loan programs, I want to start off by hard money. What is hard money? How does hard money work? And who would actually use hard money?
Hard money is mainly for investors. These are going to be your more savvy buyers. Hard money, they're going to come with stricter terms. You're going to have to put more money down, better credit scores typically. It's not going to be your first time home buyer type of program. And so I just switched over, so I haven't closed a hard money loan yet. So I'm not.
Celeste, can I just cut you off?
Yeah.
I'm so sorry. Hey, John, I just want to say this. York has a phone, and if he's making that phone call right now, I guarantee that phone call will come live on this. So you need to make sure to let him know, do not make that phone call. Because then they're going to be able to hear that conversation. So, Celeste, I'm so sorry.
You're fine.
I had to stop it like immediately because he's going to call that lady, right?
Yeah.
To set up that appointment, and they're going to hear all that stuff. So, all right.
Don't call, right?
No, I just realized, don't call right now, but can you actually give her a call through your phone? Because once that phone rings,
Hi.
once that phone rings, we could hear it. So just to let you know. All right, Celeste, I'm so sorry about that.
No, you're fine.
I just didn't want to get interrupted, and next thing you know, it's like a call that's going live.
Yeah, you definitely don't want to have a personal phone call live.
Should I be sitting like this, John? I mean,
it looks
like,
it's kind of sexy. It's a little attractive.
I know. See my booty.
You got your thigh out.
I just realized that I was like, oh, I'm gonna change this angle. I just wanted to get comfortable.
I feel like I kind of want to move this, kind of like yours.
Yeah, of course you can. Here, look.
Yeah.
You can adjust it. Look at that.
There we go.
Okay.
Now we're official.
Sorry about that, guys. So I'm gonna go back to the hard money. So it's more for like experienced buyers, investors. What is that?
Yeah, it's more for investors.
Okay.
A lot of realtors who are kind of on the wholesale side.
Yeah.
They go out, they find these deals, they find investors for it. They're usually using hard money financing. And people who are doing fix and flips, they're into the hard money as well. And so on the retail side, we don't have access to hard money at all. We just can't do it in-house. You can't do commercial. You can't do land loans.
Yeah.
So on the broker side, yeah, you do have a lot more options.
Okay, so how does the hard money work? Like, what are the terms? Like,
You
standard?
I would love to tell you about that, but I haven't closed one yet, Chakits. I just switched over yesterday, everybody. So, that's something that I'm so excited to learn about. After being in the business for 6 years, yeah, you're constantly growing, you're constantly learning, new programs are coming out, but having access to something that I've never had access to before, I'm just over the moon to dive into that.
If you find out, please let me know, because if you can get me hard money, just paying 2 points and at an 8% interest rate, that'd be great, which is, it probably doesn't exist.
I'll shop for the best rate I can get you. But yeah, typically with hard money, you're looking at elevated mortgage rates.
Which is a little bit high, but typically for the hard money is going to be more for flippers. And turnaround time is like less than 12 months. So,
correct.
Guys, if you guys are going to do something like this, you better know exactly what you're getting yourself into, because you guys can literally get hurt. Now, I just got a quick question. What are rates hovering at today, roughly?
Well, I'm excited to talk about this.
Everybody's talking about this like, oh, rates have gone down. Like, rates are still like at 7, aren't they?
Okay, so let's back up here.
Okay.
So recently this year, sometime in October, rates hit the highest level in 23 years. It was all over the news. Everyone was freaking out about it. And then November rolls around, and this month has been so good to us mortgage professionals because we're finally excited because we get to talk about something positive. And so November 1st, interest rates improved. November 2nd, interest rates improved. November 3rd, they improved. And then yesterday, we saw interest rates improve. So we saw them come down from the highest levels in the 8% range. And so now we're back somewhere in the low 7s, maybe mid 7s. And it really just depends on the loan program.
Just that fluctuation from 8 down to 8.5. You guys are that excited?
From 8 to 7.5 to low 7s. Yeah, it really impacts someone's mortgage payment.
I mean,
it really makes a difference.
I feel that based upon current home pricing, the way it is, and the way that the economy is going, inflation, for me, for 8 to down to 7, that just helps a little bit, but that doesn't encourage me to go out and buy a home. I mean, what do you tell somebody like me when I'm like, yo, 7 is still too high. Why should I buy?
So there are a variety of reasons to buy, but I like to take us on a little journey if we look back in time. So here in Las Vegas, let's talk about Las Vegas because that's what market we're in right now. So if you look back to 2020, we had the pandemic that happened, and we saw a city that was 24/7 shut down. Like the strip just shut down. It was not open. We had the highest unemployment rate in the nation. I think we were somewhere around 13%. Yet we saw home values increase, and they increased rather significantly. Now, fast forward to today, the Fed spent too much money. We have high inflation. They did rate hike after rate hike after rate hike to limit the supply of money in the economy. And then now, because of that, mortgage interest rates have increased to their highest levels. Yet this year, we saw home values appreciate. The market's not crashing. And so what that tells us is we're going to continue to see home values appreciate. So if you're a first-time home buyer, right now is actually a really good time to purchase a home. You may not think it is because the media has a completely different message, but it really is because right now, because of the season we're in, usually in the winter months, it's a little bit slower. People are focused on the holidays.
Well, are you saying it's a good time to buy now, or is it a good time because you get a better deal typically on the fourth quarter if you're thinking about buying?
Kind of both. Whether you buy in the summer or you buy in the winter, it doesn't matter, right? No matter what, in today's market, this year in 2023, you are going to have more negotiating power with the seller, more negotiating power on the price of the home, more negotiating power on things like repairs. Sellers are more likely to do repairs in this type of market. They're more likely to give you money towards your closing costs. So we call them seller concessions. And with those concessions, you can use that money to pay for your closing costs. You can use that money to do interest rate buy downs. And people don't realize you can actually buy down your interest rate permanently, temporarily. And when you buy down your interest rate, you can lower your mortgage payment. So there are options out there.
But here's the thing. I've been doing this now for 13 years. And I realize real estate, right, it's very volatile, right? Every 30 days, how contracts are negotiated between buyer and seller, they're completely different, right? And from doing this for 13 years, I feel like it's pretty common where buyers still can ask for closing costs. I think we just went through a period where we couldn't ask for closing costs. We had to we couldn't even get an appraisal. We could get an appraisal, but it didn't matter. We'd have to waive the appraisal. But that was only for a certain period of time. But customarily, if something goes wrong with the house, the buyer always asks for concessions or things to be fixed. And I think that's kind of normal. So my point is that I don't want people to be misled and saying like right now is a good time to buy. And I'm sorry, I'm going against the grain
Yeah.
because at the end of the day, this show is about both sides because I want people to see both sides. Now, if you were on the flip side of the coin and you say, hey, it's not a good time to buy, I would say it is a great time to buy because that's what this show is about.
Yeah,
because
exactly.
again, I want people to understand and think for themselves, right? So I guess my point here is that I feel like this is starting to kind of like taper off. I think it's a fair market right now across the board between sellers and buyers. Now, home prices did drop down to 420 at its low point, right? After the pandemic and all this stuff that's going on. But it creeped right back up to 450. But we know that all-time high was at the 480. Mm-hmm. Now, the question is, how high can it actually go?
Well, I don't think we're going to see appreciation like we saw in 2021.
Mm-hmm.
You know, we don't have interest rates in the 3% anymore. That was just, you know, a crazy time. That was an anomaly, right?
Yeah.
So I think we are going to see steady appreciation, more normalized, maybe somewhere from 3 to 5% per year, which, you know, brings us back to, like you said, a more stable market. But I want to piggyback off of what you said because I think it's a great time to buy for someone who is ready to buy, someone who qualifies, and someone who has the financial means to buy in this market. It's not a great time for everybody to buy, you know?
Yeah.
If you feel like you're struggling financially, it's probably not a good time for you to buy right now. It's a good time for you to hang back, work on your finances, you know, get your ducks in a row and then enter the market when you're ready. But for someone who's watching this and you're deciding if right now is a good time for you to buy and you qualify, you have the savings, your employment is stable, and you're renting, I think, yeah, absolutely. Rent is 100% interest. And right now, if you're comfortable with the payment, obviously, and it fits your budget, then, you know, don't look at the mortgage interest rate. If it's 7% or whatever it is, maybe next week it's 7.5%, who knows, right? But look at the payment. If the payment makes sense, then yeah, it's a good time for you to buy because we know homes are going to steadily appreciate probably over the next 5 years.
How much of a home should I buy?
I think you should get with your mortgage loan officer, fill out the application, and it always comes back down to the payment. So I work backwards.
Yeah.
So I take the application, I get, you know, their information together, and I ask them, what is the maximum payment you're comfortable with? And when I say payment, I'm talking PITIA, principal, interest, taxes, insurance, association dues, all of that wrapped up together. What payment are you comfortable with? And don't forget, like, you still have to pay utilities and all that stuff too. So I really have in-depth conversations with my clients, and I make sure that they're set up for success. So once I go through that, then I say, okay, maybe you're comfortable with a $2,700 payment per month. Then I match the sales price to that payment. That way I can always make sure that my client's shopping in a range that fits their budget.
I mean, with today's interest rate, 7.5%, $2,700 a month. I mean, I'm not a loan officer, but I'm saying you're probably only at like what, 300,000?
Yeah, it depends on the property. You know, here in Vegas, things like property taxes, HOA dues, that kind of stuff can vary.
Yeah.
But yeah, you're probably somewhere in that, you know, mid 300,000 range, which you can still find a great home, you know, for 350, 360, 380, especially if you're a first time home buyer and it's not your forever home, it's your starter home. You got to jump into the game at some point. Like I said, home values are going to continue to appreciate. So the longer you wait, the more expensive it could potentially be in the future.
So majority of your buyers, are they first time home buyers or investors or?
I'm kind of mixed. A lot of my home buyers are first-time home buyers. They're repeat home buyers. But then I also do have a lot of investors who are pretty savvy. My investors, you know, this year they've kind of stopped using financing and they're purchasing a lot with cash, but when the rates drop, they'll be back to do their cash out refis to continue purchasing more properties. So this is the year of the first time home buyer for sure.
So we know taxes is coming around the corner. Do you pre-set up your clients for tax seasons for 2024 going into it?
Absolutely. If my clients are self-employed, I definitely want to get with them, coach them. I usually tell them, get with your CPA, put the taxes together, don't file them, send them over to me, let me review them. Let's make sure it's in line with your mortgage needs. If it's not, then, I say, hey, let's get the CPA on the phone and let's see, what we can do to adjust those numbers to show more income. If you're just doing too many write-offs, maybe sometimes that's the problem. Or then I start looking at outside programs like bank statement loans, DSCR loans. There's a variety of options where we don't even have to show tax returns.
Now, what are qualifications to actually get approved for a loan today? Is it harder? And what do you need?
So are you talking like
qualify for a
just
loan?
like a regular like FHA, VA conventional? I would say the process is easy. You're just going to fill out a loan application. It takes like 5 to 15 minutes to fill that out. We're going to take a look at your income. We're going to take a look at your employment history. Typically, we're just looking for a 2-year work history. And there's this huge misconception that you need to work the same job for a 2-year period. Yeah. That's technically not true if you're W-2. If you've changed jobs, that's okay. We're really just looking for the work history. Were you employed and did you have a job for 2 years? That's really all we care about. Then we're going to go through, we're going to calculate the income. We're going to calculate something called a debt to income ratio. Yeah. That's why we need to pull the credit, because we need to see A, what is your credit score? B, what type of debts do you have? And can you afford the mortgage payment with your debts based on your current income? Then we're going to look at your assets, and people are like, what's that? What are assets? We're just looking at your bank accounts. Yeah. we want to see that money in your bank account that you're using for the down payment and the closing costs. And we're going to look at all that, and we're just going to verify, do you have the ability to repay the loan? And it's as easy as that. It's not rocket science.
What is that DTI that you're talking about, and what's that ratio?
The debt to income ratio. It is a basic calculation. It's not like it's calculus or anything crazy like that. Yeah. We're just literally calculating your income. So you make X amount of dollars. Let's just say you make $4,000 a month. Then we're going to take a look at your debt, and let's say you have $1,000 in debt. Let's say your mortgage payment is also $1,000. We're going to add that up. So you have $2,000 in debt, and then we're going to divide it by your income, and your debt to income ratio is going to be 50%. Generally, we want to see the debt to income ratio at 50% or less for most loan programs.
All right, that makes total sense. So, guys, we're going to take a quick break right now, and we'll be right back.
Does your house look like and have you been considering remodeling your home for some time now? Well, if you love real estate like I do and appreciate the attention to detail in the craftsmanship required to build a remodel or a gorgeous home, then I got the perfect company for you. Guys, I highly recommend Design Zone Remodeling. They are a stellar company that will turn your outdated home into your own personal sanctuary. They specialize in bathroom remodels, kitchen remodels, and full house remodels. Design Zone Remodeling has a reputation for excellent workmanship, competitive fees, and being a wide range of services and deliver the outstanding results to their clients. I use Design Zone Remodeling on my personal properties. Give Design Zone Remodeling a call today at 725-223-0871 or visit their website at designzone.com to request a free consultation today.
Attention contractors, remodelers, and homeowners. Is your renovation becoming a pain in the glass? Here at Glass Vegas, we take care of all of your glass needs. From a broken window to custom shower doors, mirrors, winding closures, storefronts, railings, and much more. We can even help you with new or replacement thermally broken windows. We're a full-service, woman-owned glass company that provides unparalleled workmanship, excellent communication, and great customer service. Glass Vegas, we do glass with class.
All right, guys, and welcome back to the LV Home Experts Podcast. I'm with Celeste today. We're talking about mortgages and how all that stuff works. And I want to talk about the Las Vegas market. But before we get into Las Vegas market, what's happening around Las Vegas? Because there's a lot of things going on right now.
There's a lot, man.
Which is crazy. The Strip is busy right now.
We have F1 happening.
Are you going to that thing?
No, I'm staying far away from the Strip, you guys. I'm not going anywhere near the Strip during that. Well, actually, I lied. I'm going to the gym. So,
okay. Well, gym on the Strip?
Okay, so I go to a gym called the Strip Barbell, and it's off of Dean Martin.
Okay.
And it's like right by the Raiders Stadium. And I have a personal trainer, and she was like, you know, let's test it out on Thursday, depending on how that goes, because I work out Thursdays and Saturdays religiously. And so she's like, if it's too crazy on Thursday, she's like, we're training at my house. And I was like, okay, cool.
Okay.
But I went down there recently, and holy smokes, there's like a random bridge on Flamingo that was never there. They straight up built a bridge.
Which is kind of crazy because I actually did a video because I actually was driving down Kobo. I went to a SEMA show, and I had to drive down there, and I literally went down the track of what they were building, and I drove underneath that Flamingo bridge, and it was kind of fascinating how they actually engineered all that and put all that together within like months, which is kind of fascinating.
Yeah, it's insane the amount of effort and construction that has gone on in that area. It looks completely different. So I think it is cool. I think it's exciting and great for our city to be highlighted and to be chosen for the F1. But I think some of the locals are a little frustrated because it's harder to get to work. And so I have a lot of friends, they still work on the Strip, and they say they leave their house, you know, at least an hour and 15 minutes early just because the traffic has gotten so bad.
Well, that's kind of unfair though. You think about it, they're going to spend an hour and 30 minutes just to get to work, another hour and 30 minutes to get back home. That's like 3 hours a day.
Yep.
You know, take that, you times that by 10, that's 30 hours. Shouldn't the employees get paid? Because obviously all the casinos are going to get paid, right?
Yeah, I mean, it would be fair, but you know,
it's
business. It's business, baby. So hopefully the employees, you know, on the Strip, hopefully they'll be well compensated and they'll be so busy during F1, and it will all be worth it.
Now, I heard that they were saying something about they weren't too sure if they were going to make as much money as they expected.
I saw that too. I saw an article that said, you know, they're starting to drop the room rates and all of that. So it'll be interesting to see how all of that plays out and see if it was something for Las Vegas, if it was worth it to, you know, go through all of this. It'll be interesting to see, do we generate more money from F1 or do we generate more money from the Super Bowl?
Yeah.
I'm very curious to see those statistics.
I'm sure the Super Bowl will definitely bring in money because it's also a one-day event too as well. But obviously you're going to have people, you know, trickling in for a couple of days before and a couple of days after. And I'm sure people are going to be spending some money because the F1, I don't know if people are going to be necessarily spending money on gambling, but I'm sure they're going to be, you know, spending more money on that F1 because I think those tickets are pretty pricey too as well, what they're charging.
Yeah. I've heard they are pretty pricey. I don't know much about it because, again, I was like, I don't want anything to do with it. I paid my dues working on the Strip. I want to stay far away.
Oh, you worked on the Strip?
Oh, yeah.
Where at?
So when I first moved to Las Vegas, so I graduated from college in San Diego, and I just like got this wild hair, and I was like, I'm going to move to Vegas. And so I just moved here, and I started working at a nightclub called Dre's, and that was my first
And that's off of
job.
Flamingo too.
Yeah, that's right
Yeah,
off
yeah.
of Flamingo at the Cromwell. I was on the rooftop, and that was super great. And then from there, I moved over to the Wynn. I worked at Excess Nightclub, Surrender Nightclub, and then I was like, okay, I had my fun, paid my dues. I feel like a real Vegas local now. I mean, are you even a real Vegas local if you've never worked on the Strip? I don't think so. And then I entered into the mortgage business after that.
Interesting. It seems like everybody that I know that is in the real estate business basically worked at the Strip or came from the nightclub. It's just kind of crazy.
It's something to do with customer service.
Yeah.
I mean, you know, going from a service industry job and then, you know, phasing into a sales position, especially into real estate or mortgage. You know, we know how to build trusted relationships. We know how to communicate well with our clients. So it's always a good fit.
Now, I want to go into the housing market. From your perspective, what do you see that's going on like right now?
Well, for my clients specifically, I'm seeing them being able to be a little bit more choosy and take their time with shopping. You know, if we do compare it to 2021 and early 2022, I felt like a lot of my clients felt rushed, like they had to hurry up and put in their offer because there was a multiple offer situation. Now they have a little bit more time to, you know, look at homes, maybe, you know, go look at it a couple of times, make sure that it's really a good fit for them. And then when they're making their offers, you know, within reason, they're able to maybe try to negotiate some seller credits. So I really like the direction our market is in right now. I feel like it's still great for the seller and it's still great for the buyer. It's more of a stabilized market, in my opinion.
Now, is your buyers getting more concessions than before, you were saying?
Yes. Yeah. This year, I want to say this summer, I had probably half of my clients were getting concessions, anywhere from $1,000 all the way up to like $13,500. And we're using that money again to pay down closing costs, buy down interest rates, versus, you know, if you look back at early 2022, I remember I had a client who paid $35,000 over appraised value.
Oh, wow.
That's how drastic the market has changed, where now I feel like most of my clients are getting homes at value.
Now, if you were able to get $10,000 concessions, would it be better to use that $10,000 towards, you know, your buy down or your closing costs?
It really depends on the client. So if I have a client who is short on funds, like maybe they have enough money for the down payment, but they don't have enough for the closing costs, we're definitely using that money for the closing costs. But maybe I have a client who has enough money for the down payment and the closing costs, and now we're going to look at interest rate buy downs. And so we'll sit down and we'll price out a few scenarios for permanent rate buy downs and temporary rate buy downs. There are options. A lot of people don't realize there are options when you're buying down your interest rate. So you can buy it down permanently, which means your interest rate that you lock in on the permanent rate buy down is your interest rate for the next 30 years. Let's say your loan is fixed on a 30-year term. It's that same interest rate for the next 30 years. On a temporary rate buy down, you're still locking in the market rate, and that payment at the market rate is always being paid, but we're using the seller's money to subsidize the difference in payment. So we're really just paying the difference in interest from the temporary rate to the market rate. So temporary rates, you know, are usually anywhere from 1 to 3 years. And there's a lot of different options. You can do a 3-year buy down, a 2-year, a 1-year, a 1-1 buy down. There's so many different options for the temporary rates.
Why would somebody want to do that? I feel like that's the worst thing that you could do is to do a 3-2-1 buy down. Like, why would I do that?
Well, in a high rate environment like we're experiencing today, we do believe that at some point interest rates are going to move lower, probably, hopefully within the next, 12 months to 5 years. The issue is we don't know how much lower they're going to move. A lot of the experts think, by the end of this year, rates are kind of going to hover somewhere in the low sevens. And then by the end of 2024, rates are going to hover somewhere, hopefully in the low to mid sixes. So they're not just going to like drop down to 3%. So if you are doing a temporary rate buy down, you do need to be comfortable with the market rate, because after, that temporary period is over, if you don't have an option to refinance, if rates haven't moved low enough for it to make sense for you to refinance, then you're going to be at that market rate that you locked in.
I want to go back to closing costs. If you're able to get the seller to contribute towards the buyer's closing costs, how much of a closing cost can you ask for? Is there a max?
There is a max, and it's dependent on the loan program. I believe FHA is about 6% of the sales price that you can receive in interested party contributions. So whether that's from the seller, from any interested party like the real estate agent or the lender. Conventional, it depends on how much money you're putting down. So if you're putting down the minimum, the max you can get is 3% credit from interested party contributions like the seller, or you can go up to 6% if you're putting about 10% down.
Okay, so it's all a case-by-case basis.
And it is also different for if you're purchasing a primary residence versus an investment property. Investors are capped at 2%.
Okay. So you are required to put your own down payment down. You can't have somebody to put a down payment for you unless they're a family member, right?
Correct. Yeah, the seller cannot pay for your down payment, but they can pay for closing costs and other fees. You can get a gift money from your family. You can use down payment assistance programs, which we have some great down payment assistance programs here in the state of Nevada. We have the Home is Possible, and they have a variety of programs that are available. We have Nevada Partners, which they have the Culinary Union program, the WISH program. So there are options.
People still use those programs till this day?
People are still using those programs.
When was the last time you did one of those programs?
I would say the last time I did down payment assistance was probably earlier this year.
Oh, really? Because I haven't done one of those for like a while.
Yeah, they've always been around. They're always there, and they're available, for anyone who qualifies. I would say the hardest part of the qualification, it always comes down to the income. The income limits are so low for some of those programs, and right now with the higher interest rates, it can throw the debt to income ratio off. And so I do wish that they would really adjust those income limits on those programs so we can help more home buyers out there be able to qualify for the down payment assistance.
Now, you mentioned something about you think rates are going to drop in the next 12 months, and another 12 months it should drop again. And I know that you said that that's what you're hearing from experts. What is your thoughts on that? Do you feel that that's accurate?
I feel like when it comes to interest rates, I feel like the experts have gotten it horribly wrong. Like we've seen them make predictions for this year and they were just way off. So I think it's really hard to tell. I think the market's still volatile, but now we're starting to see information come out that would support interest rates potentially moving lower. So one of the things that really impacts mortgage interest rates right now is inflation. But now we're starting to see with each report that comes out, and so for you, those of you who don't know, inflation reports come out every single month, and the reports we're really looking at are like the PCE, CPI reports, and recently we've been seeing, every month inflation moving lower and moving lower. And because of that, we're now starting to see the Fed pause on rate hikes. So yesterday CPI came out lower than expected. That was good. We saw.
Aren't those always adjusted? They
can be adjusted. So, that impacts things as well, which is why I say
Yeah.
things are still volatile. They're looking better, but
Yeah.
things are still volatile. You know, and we had the jobs reports come out. Those were weaker than expected. So that was good for mortgage interest rates. And so the Fed is kind of using this information to measure inflation and to figure out what their next steps are going to be. So we should expect, you know, on December 13th, their next meeting, for them to do another pause on rate hikes.
So you think they're going to pause again on this next one?
Yes. Yeah. Based on the jobs reports that have come out, based on the inflation data that's come out, based on that information, yeah, we are expecting them to do a pause. Now, if they don't do a pause, that will totally cause a ruckus for mortgage interest rates.
Yeah, I feel like the Feds, honestly, with core CPI and all these index, I think they're all false. You know, when they first come out, they're great, but they always get revised after 30 days. The numbers are not correct. And I think right now the Feds are really chasing inflation, and the only way to stop inflation is by increasing rates, right? To slow down the economy. But obviously you can't slow it down too much, because when you slow it down too much, then, you know, we can run into some problems.
Oh, yeah.
But the question is, you know, it's going back and forth. I mean, how high can you raise interest rates, and how high can home pricing go, right? Because I mean, right now a home is at $450,000. Average household income here is only $80,000. With rates at 7.25%, I mean, man, those payments are so high.
It's tough.
It's going to come to a point where, you know, people can't afford to purchase a home, and if they can't afford to purchase a home, then what happens? There's going to be more supply than less demand. But I think one of the problems that we're having is that with inflation running so rampant, right, people are repositioning. They have no clue like where to go, what state to go in. Cost of living is just getting more expensive. Vegas is like one of the cheapest places to live, honestly. Even though for me, you know, being here now for about 20 something years, I remember back when things were like so cheap. Now it's like, for me, it's expensive, but then you have other people that move out here, especially like my clients from Hawaii or from California. They're looking at pricing out here and they're like, dude, this is nothing. And that's, I think that's part of the problem, where, you know, we're getting such an influx of people are just moving here and really forcing the price or to stabilize this market. But my question is, how long is this going to last until people start to realize, like, you know what, we can't go up anymore. This is just getting ridiculous. I mean, who is out there making payments, right, for like $3,800 a month on a $450,000 home with an average household income of $80,000? To me, that just does not make sense at all. Like, I make a good living, right? And I'm looking at $3,800 a month, and I'm like, screw that. You're out of your mind.
It's tough. Yeah, it's tough. And it's one of the challenges that we're facing. And I feel like mortgage loan officers were, you know, on the front lines of that. You know, we're the ones who are sitting down with the clients, reviewing their budgets and having to readjust their expectations. So sometimes, you know, maybe you're not going to get that house with a pool. Maybe you're going to have to readjust your expectations and, you know, get a house that is more affordable for you. I do think it is a big issue. And I think it's not just Californians and other, you know, clients from Hawaii moving here to our beautiful and vibrant city. It's also, you know, you have these hedge funds and corporations coming in and buying up whole communities, and you know, and they're taking away inventory that we desperately need for people who are purchasing primary residences. So I think there's a variety of issues. I think we're going to need some type of government intervention to come in and, you know, save the day for these people who deserve to be able to afford to purchase a home.
The crazy thing about it is I have friends that were in the mortgage industry. You know, they started when I started real estate. They're no longer in the business, and they were doing pretty damn good. Like, I give it to you. You're still able to survive and weather the storm. I mean, it's pretty hard for mortgage brokers out there right now, because like all the guys I know in this industry, they're struggling. Yeah, it's not an easy business. I'm sure your guys' loan application is probably hella low.
Yeah, I want to say like home sales in general are down. Overall mortgage applications are down. We've seen a ton of professionals exit the business. It has not been easy this year, but I just stay focused. I stay focused on my one mission, and that is to help as many individuals achieve the dream of home ownership and create wealth through real estate.
Okay.
And I feel like if you have a passion and you really believe in that, like you're going to do whatever it takes to get through the market, to survive, to keep serving your clients.
How are you able to compete against new homes?
It's been tough. I'm going to be honest with you. It has been very tough to compete against home builders this year. It's almost impossible. So I've lost, I don't know, maybe 10 million in production this year to new home builders, just because, we just can't compete. When you're out shopping for a new construction home, the builder, typically owns the mortgage company. They have some type of relationship with the title company. Sometimes they even own their own like home insurance company.
Yeah.
And so, when you're going out and you're shopping for a new construction home, they're going to offer you all of these incentives to use their mortgage company. But they won't offer those same incentives if you use an outside mortgage company that they're not affiliated with. And so we just cannot compete with what they're offering, because usually the builder is probably taking that money from their profit on the sale of the home.
So are you guys pretty close with the competitive fees, or they're just like blowing you guys out of the water?
We're close when it comes to like fees, but if the builder's like, hey, I'm going to offer you $25K in upgrades, and then I'm going to offer you, $10K to pay off your closing costs, me as Celeste at, my mortgage company, I'm like, I can't offer you $25,000 in upgrades. I can't offer you just make $10,000 appear out of thin air. And so usually, in this type of market, sometimes the client decides to go with the new home builder. And that's great. And, I advise my clients, it's okay if I can't match what they're matching. Go ahead, go with them. That's what's in your best interest. When interest rates, move lower and it makes sense for you to refinance, I'll be giving you a call. I'd love to do your refinance.
How many people normally refinance? Would you say every single buyer ends up refinancing their home?
It just depends. Like, I have a ton of clients who purchased homes in 2021. Are they ever going to refinance? I don't know. Probably not, because they have, ultra low interest rates in the 2 and 3% range. I don't think interest rates are going to get that low ever again.
So basically those homes, if you think about it, is pretty much locked up and stored.
Yes.
Right? Those homes will probably never come up on the market for sale, right?
Nope.
And the sellers won't sell it. They'll just hold on to it. They'll just rent it out. Or this is a home that they keep forever because they didn't buy a house. They bought a mortgage at that time.
Mm-hmm.
So now that puts up more demand into the marketplace. That's another problem that we're running into.
Yeah, is that number one, we're short inventory. We have so many new household formations coming onto the market, meaning individuals who are now ready to purchase homes. We have people who have already purchased homes who don't want to sell because they don't want to give up their ultra low interest rates. And we have those people keeping their homes, renting them out, buying new homes, upgrading to new homes. So it does put a strain on the inventory, and that's, also what's holding our home values up as well. So I don't know how we're going to solve that issue in terms of, inventory. So I think it is what it is. This is the reality. And that's why I say the sooner you can get into the real estate game, the better it is for you if you're a renter. Because like I said, rent is 100% interest. Your landlord can increase the rent if the market allows for it. And at least if you have your own home that you own and, you know, you have a mortgage payment, as long as your interest rate is fixed, you know, that's really not going to increase. Yeah, your property taxes might increase, your HOA dues might increase, your insurance might increase, but at least the money that you owe to the bank, that's at a fixed rate. And so that can be a game changer for a number of families.
I think you also have a lot of buyers, especially investors, kind of sitting on the sidelines because they want to see what's going to take place. But I feel like more the buying side, they're trying to time the market, which is, I've been doing that now for 13 years. Hasn't really worked for me, which is kind of crazy because I'm like, maybe I should buy this. Nah, I'm not going to buy. Next thing you know, home pricing keeps going up. I'm like, nah, this thing's going to tank. I'm going to wait till rock bottom. And I still think that way. Right? So my question to you is, do you ever think the market will ever drop like 50%?
I think if that happened, something crazy would have to happen, something significant. I don't even know what it would be, but if that happened, man, we would be in a world of hurt because, you guys, this is not 2008. You know, when we're qualifying people for mortgage loans, we are really making sure they have the ability to repay the loan. We're verifying their credit, their income, their assets. You know, the loan goes through a whole process. It's not like 2008 where we could just, you know, write on a piece of paper, yeah, I make, you know, X amount of dollars and just get someone into a home. And, you know, we don't have all those risky products like we did in the past. So for home values to just significantly drop and for people to be upside down on their homes, something insane would have to happen.
Here's my concern. We have about $32 trillion in debt. In the next 3 years, we need to pay off $17 trillion. That's what's coming due. So we got to pay it one way or another. And when I say we, I'm talking about me and you. Right?
Yeah.
Another thing that we're looking at is credit card debt is an all-time high. Also, credit card debt now is starting to have delinquents, right? If you look at the auto sector, right, during the pandemic, a lot of cars were selling. Now, car sales are slowing down, and also there's been a lot of repos, okay? Now, these are kind of like red flags for me, right? Because we went out, we printed all this money, we spent all this money, we force the appreciation up on everything, right? Because of inflation now at this point. Feds are having a hard time to slow down inflation. And I feel like they're manipulating things. And I feel like something's coming around the corner. I don't know what it is. And I don't want to be that. Matter of fact, I am that guy. Doom and gloom, right? So I'm just a little bit paranoid. Right? Because just what's going on in the world today, things are getting expensive. I went to the gas station, I'm pumping gas, and I'm filling up my tank, and I'm clipping about $150 each tank, and I got 4 cars. Grocery is matter of fact, I'm lying. I don't even go grocery shopping. So let's discard that, okay? When I go out and I eat food at night, right, because we always have dinner, I'm looking at the bill, I'm like, okay, you know what? 100 here, 150 here, you know, all this starting to add up. Like, things are getting more and more pricier. It's going to come to a point where, guys, we can't afford all this. So something is around the corner. I don't know when it's going to happen. But I also feel like that consumers should also be prepared as well and not spend too much on a home. And what I mean by that is we talked about the debt to income ratio earlier, right? Number one, you need to have a stabilized job where you're not going to lose your job, right?
Correct.
And number two, it's like, look, don't spend 43% of your income on a home. I feel like that's just way too much. Because I feel like lenders, right, always peg out the clients like, hey, this is what you could be approved for. But I realize a lot of times consumers end up spending the full amount with their debt to income ratio. It always happens. And I feel like, honestly, on a conservative side, you should be anywhere from 15 to 20% max. Like, my debt to income ratio just on my house alone is less than 5%. And I keep it that way. And a lot of people, you know, like the big houses, like the modern houses, you don't want to be house broke. And I think that's how Americans are today, where their house broke, their car broke. I mean, they live a life of debt and they don't really own anything. And I think we need to educate people and let them know, like, hey, it's not only about, having a nice car, having a house. It's actually the quality of life that you should be living. I mean, what's your thoughts on that?
I 100% agree with you. And that's why I spend a lot of time with my clients going through the budget aspect of the application and just narrowing it down and trying to bring them back down to reality. I think, it is really important to make sure you're in a mortgage payment that you can sustain. If you fall on hard times, do you have reserves that you can tap into? I personally have 12 months of mortgage payments saved up. I'm, a little bit crazy, but I have 12 months of liquid cash in my bank account for mortgage payments saved up. So I think... we do need to be out there educating consumers. It's okay to drive an old car. I drive a Toyota Corolla. It's paid off. I love my car so much. I have super low debt. And I try to, give my home buyers the same education. But you can lead a horse to water. You can't make them drink it. So, there are some clients who, maybe might max out their debt to income ratio, but sometimes they have dual income households. Like I had a client recently, I had his debt to income ratio at 56.9%.
Ooh, that's high.
That was the highest I could push it. But I wasn't, worried about it.
Take it out of like 99 or something.
I wasn't worried about it because we had the conversation and because, his baby mama, she was also working, but she wasn't on the loan application. So, you have those situations too. Or sometimes I have clients who are like, my brother's going to live with me and he's going to pay half the mortgage. So, I don't want to ever discourage somebody from, trying to purchase a home. Everybody's financial situation and circumstances are different. And that's why it's really good to get with a mortgage professional who actually cares, who's going to have these conversations with you and talk to you like a friend, rather than just going to some Joe Schmo off the street who's like, yep, here's your pre-approval, and like doesn't talk to you or explain anything to you.
Now for me, like real estate is kind of like a game. Like I was just talking to a client the other day. He was like a VA buyer, right? And he's like, should I buy a home? I'm like, dude, it's totally up to you, but let me explain something to you. You're a VA buyer. What is the worst case scenario that's going to happen? You buy a home, we negotiate your closing costs. Let's say you're into this deal all in for like $4,000. Let's just say that. The market goes to shit. What do you lose? $4,000? Like, let's say if you wanted to walk away, you really lose only $4,000. But not only that, like I said, real estate is a game. You can play the game, right? We can do some sort of loan modification, because if the market tanks, the whole world tanks. So now, obviously, government's going to step in. So we play the game. We can do a loan modification. We can do a short sale. I've done this back in the day in 2010, 2011, where I had investors where we did strategic short sales. Their credit went to shit, but we repositioned their portfolio. Then within 2 to 3 years, we rebuilt everything up. And now we went out and we bought more properties. And now they're like back to being multimillionaires. And real estate is a game. So I explained that to him. He was like, you know what? You're absolutely right. I only lose $4,000. I ain't got nothing to lose. That makes total sense. But now on the flip side, if you're a conventional buyer and you don't want mortgage insurance premium, you put down $20,000, 20%, $100,000 on a $500,000 home, and home goes down from $500,000 down to like $200,000, then yes, now you're tied to that property because you're fully invested $100,000 into that deal. So that's a completely different story. So my point here is that I want you guys to really think about this, right? Because sometimes is it worth the risk or worth the reward? So it's a case-by-case basis. So like another example, like for me, I already put so much money into my home. If the market tanks, I'm not going to leave or sell because I have such a low mortgage payment, right? So it makes sense for me just to keep it forever. So I don't care about the equity going up and down. All I care is about the payment. So my point is, it's a case-by-case situation, but it's how you look at that situation. How do you always look at your exit strategy? And I think people need to take a look at their exit strategy. And I think that's important.
Yeah, I'm glad you brought up that point, because let's just say something crazy happened, home values went down. Do you think the banks want to foreclose on you?
Hell no, it costs them more money.
They don't. They're going to come up with programs. They're going to come up with solutions. They're going to try to keep you in your home. They just want you to make the payment. That's all.
That's how they make their money.
Yeah. So, there's going to be solutions, but I always tell my clients, when you're buying a home, especially in today's market, take your time. You have the opportunity to take your time, look around, find a home you really like, a home you can see yourself living in for at least the next 3 to 5 years, just in case, something crazy happens. Like Chakits said, there's, things brewing. We got some ugly stuff under the rug right now with consumer debt and our debt as a nation. So we don't know what's going to happen, but we can sit back and we can be afraid and be paralyzed by fear, or you can go out and achieve your dreams of home ownership and prepare and plan just in case something were to happen. Make sure you have your finances in order, make sure you have some savings, make sure the payment's not too high, that if you lost your job and you had to find something else, could you still cover the payment? If all of that makes sense, then yeah, buy a home. Why are you renting?
You know what? You made a very good point, and I really do appreciate, you coming out here, taking the time to talk to all the viewers out here. Now, if somebody wants to start the loan process, okay, with you, and they want to have that conversation, what is the best way to get a hold of you?
The best way to reach me is to just give me a call. I'm old fashioned. Just give me a call, shoot me a text, send me an email, say, hey, I saw you on the podcast, would love to connect. We'll schedule a time to talk. I'll take your application. We'll go through all your budget and all of the things we talked about here today. I'll give you a personalized experience, and we'll decide if it makes sense for you to buy in this market.
John, you want to pop that number up on the screen, please? Go ahead. No, I'm just kidding. We ain't there yet, guys. I'm calling John out right now. All right. Hey, so what is that number?
702-715-9061.
And email address, website?
My email address is charvey, so CHARVEY at emortgagecapital.com.
Okay, so if somebody wants to start the loan process right now, what's the website?
You can go to www.celestehomeloans.com.
Okay. Also, guys, what I'm going to do is I'm going to have a link in the description below as well. So if you guys want to get the loan process started, she has all different types of programs. She has tons of them. I'm talking about tons of them. Go ahead and click on the link in the description below. And Celeste, thank you so much for coming on out here. Other than that, until next time, guys, next week, Wednesday at 4 p.m. Pacific Standard Time, we have a real estate guru that's coming up on the market. She's done multi-million-dollar deals, and we're going to talk about the Las Vegas housing market. All right, peace.
And projects backed by our 20 years of experience. Whether it's a closet, pantry, garage storage, floor coatings, entertainment center, laundry room, home office, custom bookcases, and window coverings, Closets Las Vegas will give you the look and feel you want in your home. Please contact me, Pat, for your free consultation, and don't forget to ask about 0% financing for 18 months. I look forward to working with you.
Hey, what's up, everybody? Did you know that 96,000 people move to Las Vegas every single year? The question is why? Well, due to the Fed's interest rate hikes have increased the cost of living for many Americans across the country. Americans are now looking to relocate to Las Vegas because of no state income tax, low unemployment,